Hello, everyone, and welcome to the TheraSAS podcast, where you get to learn about marketing, growing, and scaling your private practice. I'm Brent Stutzman, and today we're going to be talking about tax-saving tips for practice owners. And to help me do that is Alan Pruitt, founder of The Therapist CPA. Alan helps therapists build financially healthy, sustainable private practices with less stress, fewer tax surprises, and clearer numbers. With over 17 years of CPA experience, Alan specializes in serving therapy practices from solo clinicians to multi-provider groups. His work is also personal. His wife is a licensed professional counselor, supervisor, and a private practice owner, giving him firsthand insight into the financial challenges therapists face. Through the Therapist CPA and the Profit Therapy community, Alan helps therapists reduce financial anxiety, keep more of what they earn, and build practices that support both their purpose and their life. Fun fact, Alan owns over 52 watches and still runs on therapist time. Love that little tidbit at the end. And I noticed when we got to hang out a little bit, our booths were right next to each other at the Joe Sanok's group practice conference.
Yes.
I noticed one of those watches. I was like, man, Alan, that's a big watch.
Yes. What can I say? I am a watch aficionado. Definitely have over 50 watches, because you got to have one with every outfit. Got to have just a little bit of flash to it. So what can I say?
Well, I've never gotten into watches, but I feel like some of my friends now are into watches. Like it's kind of a thing. And I was like, where did this all come from? And then sure enough, one of my friends had a Rolex, and he just went down the Rolex rabbit hole. And he's like, well, here, Brent, here's the value, retains it, it's going to grow in value. It's demand. I was like, whoa. Like,
there you go.
Hold on. This is a lot. And then I was like, well, tell me what's better than. So anyways, over lunch, I just, I opened up a can of worms on that. So I know watches.
Right.
But I don't know if it's a newer thing or if it's because of F1 racing. I don't know. But
I can say I like your friend already, because a Rolex, a timepiece like that, it's an investment, Brent. It's an investment.
Yeah, that's exactly what he said. But speaking of maybe some investing, I don't know, but we're going to talk about some tax saving tips. So I'd love for you to just jump in and share with our listeners what you have to say, and then we'll have a conversation along the way.
Yeah, absolutely. So glad to be here to talk numbers. I know that's something that the therapists often shy away from, but when it comes down to March and April, and the tax return is due, and you've had a practice you've been running all year, there's no more hiding from it. But here's the good news, though, is that if you do just a little bit of proactivity, be proactive and plan ahead, you can make tax season a lot smoother. So, one of the things I like to tell our clients, and what I want to tell your audience, is that here's the thing that most therapists don't realize, is that there are actually two tax seasons. So everybody knows about the first one that we just talked about. Everybody knows about the tax paying season, beginning of the year. What do my numbers look like? What does the tax bill look like? So on and so forth. So everybody's familiar with that one, and nobody really likes that one, just to be perfectly honest, especially practice owners. And, we've seen it, especially those who are in maybe their first couple of years of a practice, just not really sure where things stand and, what that tax bill is going to look like. But here's the thing that most therapists need to realize, is that the second tax season starts after April 15th. And we like to call that tax saving season, because the next 8 months of what you do throughout the year actually shapes your next year's tax bill. And so we want you to be proactive. We want you to get ahead of it. So then that way you're not reacting to things that happened last year, and you're not avoiding them. If you take them head on, it's a lot more manageable. I tell people, think about the boogie monster under the bed, right? Well, if you just turn on the light and look under the bed, is not as scary once you open the closet and take a look. But if you never take a look, and you hear a weird noise and you try to avoid it until it's April 14th, then you might get bitten. So we just always like to help and help be ahead of the game and not behind it.
Yeah, that's really important, because you don't want surprises when the tax bill comes due, because it will. And that's something that my wife and we've been planning. Like, I feel like after paying taxes, now it's like we know exactly what to expect because we've taken that second tax planning or saving season pretty seriously. So when we get the bill, I'm like, all right, this hurts, but the money's there and we're gonna go ahead and pay it.
There you go. And that's part of the battle there. It's like, hey, if you work on that throughout the year, and one of the things we do for our clients is we actually build your tax return throughout the year. So we actually each quarter we have quarterly tax planning meetings, with our therapist clients, and we actually build a tax return. It's like, hey, based on what we look like, based on your tax profile, hey, what are the projections of your business? Hey, let's put that all into a tax return at least once a quarter and see what it is. We give you quarterly tax estimated amounts, just like you're talking about, hey, making sure we're setting that aside, because then guess what? Then it's not as scary. You're in front of it. You kind of know what it's going to look like. And then if you're tax planning and getting some of the deductions that we're going to talk about a little bit later in there along the way, it all ends up being much, much more manageable.
Yeah. Love it. Love it. Keep going.
Yeah. So yeah, absolutely. So one of the things that I like to tell clients is that you want to make sure that you are, naturally have that proactivity, because in that mindset shift is you have to think about, even honestly, you have to think about your tax preparer or your CPA a little bit different, because a typical tax preparer, they report the history. You come to them in February, March, April, we're looking back at the prior year. But guess what? There's not as much we can do about the prior year once it's done. So that's why, I always harp on, and I think it's so important to be proactive, because when you get with the proactive planning CPA, then guess what? You can take that bill head on. A proactive CPA helps you shape the bill during tax saving season to make sure that everything is smooth. You're getting all the deductions. And guess what that helps out with? That really helps out with your overall profitability of your practice, because guess what? Taxes are going to be probably the largest expense behind payroll. If you are a group practice owner, everybody knows how big payroll costs are. And of course, that's just the, cost of doing business to have good people in your practice. But probably not too far after that are the amount of taxes you have to pay. Perfect example. And I hate seeing it. And that's what I was saying. Usually for therapists who come in around their second year, maybe their first year was a part year or something, then they hit their stride in their second year in practice. We've had new clients come in and, we start putting their prior year tax return together. They're still getting to fill out what this new practice looks like. And, we look at everything and we're like, sorry, we're looking at a $15,000-$16,000 tax bill that they hadn't planned or prepped for at all. And you hate seeing that, because therapists work so hard, for their money, do such great work overall. And so we want to make sure that you are keeping more of what you earn. I tell all of our clients, hey, I love tipping waitresses, but I'm not quite a fan of tipping the IRS. And so we don't want you to tip the IRS either.
I love that metaphor. That's right. Yeah, not to tip the IRS, and rather, save some money than tip your waitress well.
Absolutely. Save some of the tax money and let's tip the hardworking waitresses. Let's do different things in your practice. If you have, therapists, let's have some things, some team building activities with them.
Take them out the lunch.
Exactly. There's so many, and which is a tax deduction, by the way. So there's so many different things that we can be doing, as the overpaying in taxes, and we see it all the time. And so the best way to typically avoid that is, the first thing is you just have to know your numbers. Like there's no way around it. I know most therapists and private practice owners are very, very scared of the B word, but budgets are not all bad. So we want to make sure that throughout the year you are budgeting, you are projecting, you're looking at what your numbers are. And so I tell our clients it is very important, if you are a solo practice owner, to know what your numbers are. It is very important. If you are a group practice owner, it is imperative to know what your profit per session is. You need to know your revenue per session, your overhead per session, and your profit per session, because this allows you to, one, run your practice a little bit more smoothly and to understand, hey, for each additional session that somebody on my team adds, this
Hmm.
is how much more money we get to the bottom line.
Yeah.
And then once we know that, we know how to plan and prep overall for the projections, but then also for tax planning, for taxes, for that type of things. So that is always very critical to know. So that's the first thing. Like top line revenue is
Yeah.
great. As I've heard the saying go, top line revenue is vanity, but profit is sanity. So you want to make sure, hey, we need to know our top line revenue. But as we know, hey, we don't get to keep all the top line revenue. We want it to keep growing. But what really matters is the profitability. And so, and another thing that therapists have to realize is that there are two very different things. So busy does not equate to profitable.
Hmm.
So we know most therapists are busy, running their practices, whether they are, seeing sessions, having sessions themselves, running a practice more, some are more like a, CD clinical director. But you can be busy without being profitable. So once again, with taxes being such a huge portion of what you pay, how about we make sure that that is manageable, that we're taking all the tax deductions that are
Yeah.
possibly there for us.
I love that. Top line is vanity, bottom line is sanity.
Exactly.
That's really great because a lot, you hear these podcasts or you hear like these gurus online. They're like, I
Mhm.
made $2 million or whatever, and then but I'm like, but what was your profit, brother? Like,
Exactly.
like,
You were
like,
so right. You're
good
spot
for
on.
you. So like even if there's any practice owners out there, if they're kind
Mhm.
of they like to flex their numbers a little bit, just dig them like,
Yeah,
but man, what was your profit? I mean, because not
absolutely.
just sanity, it's like it can make them sad,
Yeah.
you know?
Yeah. No,
So
you're right.
you gotta know that. And then I love this profit per session. So as you're looking
Yes.
across the landscape for the
Hmm.
practices that you're working at, what is
Hmm.
a healthy, if you can give a little bit of a range, red zone, like warning, like no profit, but let's just say, what is kind
Yeah.
of that threshold? You want at least this much profit per session to have some
Yeah.
sanity. And then what does on the top end of profit, like, hey, this is really healthy. You're going to be you're thriving at these numbers.
Yeah, yeah, no, that makes a lot of sense. So it often depends on as any good CPA tell you, it
Yeah.
it
Okay.
depends, right? But just to kind of give you some general overall numbers, because depending on what type of practice you run, things change slightly. So
Mhm.
as most people know, when you have a group, when you have a team, when you have W-2 employees, those are going to be a little bit more expensive than having a practice of
Right.
1099 because you have to pay the payroll taxes, on top of that. But I tell people that, don't shy away from it. One, there are some, legal ramifications, of course, W-2 versus
Yep.
1099. But then also, usually for a W-2 practice, it makes those employees a little more sticky, what I like to say, because there's a little bit more security. So although you're paying a little bit more, that is quite all right. So, and then from there, what I do shy practice owners away from is just doing, even though they're W-2, just doing an outright salary. Because the outright salary without the set number of sessions, I've seen that go bad so often. So I've seen practice owners where they are, definitely overpaying their staff versus the
Yeah.
actual revenue that's coming in. They're losing money. So that's never a good situation. So what you want to look at is, one, the level of practitioner that you have and what your compensation package is to them. That is what that's the first thing. And I've seen it so many times because by nature, therapists, and you might be out there and can relate to this. You guys are very compassionate people. And
Right.
I've seen therapists who have come from not so great group practices. So when they go and want to run one, they sometimes want to be a little bit overly generous to the compensation structure. So I always tell our clients, I was like, hey, if you want to make me the bad guy as your CPA, make me the bad guy. I'll take all the smoke. Where it's like, you know what, Ashley, I would love to pay you this amount, but this therapist CPA guy of mine says I absolutely can't.
Yeah.
Because you don't want to do harm, to the practice overall. So here's what we typically say. Of course, this depends on practice size and whatnot. But if you think your typical therapist, you might pay somewhere between 65 and 75% of what they earn, they get to keep. So give or take somewhere within that range. Usually we've seen that number go off the rails, but usually that's what the case
probably
might
for
be.
Contractor. For employee, that's going to be really high too, because you have the additional payroll taxes on top of that.
Have additional payroll taxes on top of that, which is usually going to add, give or take, about 8%. So payroll taxes, you're going to be looking at about an additional 8% on top of that number. So if we kind of work backwards from there, if that's the revenue generating piece of it, let's just say we land on 70%, right? So then you as a practice owner, you're keeping 30% of the other side. So that means that all of your expenses have to fit within that 30% to make it profitable. So once again, depends on how large you get. But, we like to have people, make sure that you're not going, I'd say over of that 30% that you get to keep, not going over 15 to 20% of that remaining amount, because then that keeps you at least in a pretty good safe space. So we kind of like to work backwards, looking at, hey, what is our, how many sessions does, our clinicians have? How much are we paying them? If we're paying them 70, guess what? If we're paying them 70 all in, including, benefits, taxes, all of that stuff, we get to keep 30. So that means out of that 30% that we need to have our overhead. So what now?
Yeah, because you run your business on that 30%, which can be tight too. Like depending on if you're your lease and all your software and all that other stuff.
Exactly. It can be very tight. So
and the other thing
ideally don't want to.
Oh, sorry to interrupt. Can I just share a lot of these states like Colorado, Utah, Illinois, California, they are throwing down more employment, should I say, requirements and it restricts the practice owner even more. So you have to, here's what I'm telling like my wife and other practice owners, you have to actually pay less than you think. And it might feel like it hurts, like you're not being generous, but these states are putting way more employment laws in and that are costing practice owners a lot of money actually. And so they just have to leave room, because the worst conversation to have is like, look, I have to pay you less. I have to pay you less now. You don't want to have that conversation.
No, because that doesn't feel good for anybody. You are absolutely right. So that's why that's why we kind of help and guide our clients with that on the front end, because once you make that compensation package and structure, it's hard to go back on it, so we want to guide clients with that on the front end. So no, you're absolutely right. So you have to look at that all in, top to bottom. Go ahead.
Yeah. So we talked a little bit about percentage. I just real quick before you go on to the tax tips.
Sure.
I wrote down here, is there like a dollar amount? So let's say if you can get a minimum dollar like a dollar amount on profit, that's helped like per session. Like what does that look like? Do you have any numbers on that you can share?
Yeah. So I would say if we are at least keeping as like profitability numbers, I feel like if we're at least keeping 20% of what your revenue is per session, then I feel like we're in a pretty decent spot. So, we kind of have to work backwards from there naturally. But, bottom line in it, if we're at least at about 20% of per session. So if our average reimbursement rate is, $100, if we can make sure that the profit is about 20% of that, I feel like we're, for most
that's like all
owners,
in after all your expenses, after everything, just the pure bottom line, straight net profit. $27 profit, like cash, even after paying yourself, that would be okay.
Yes.
Yeah. At least $27. Yeah. I mean, what I typically was like, when I work with private pay clients and things, I'm like, look, you need to have your sessions at least $150. If you don't have to deal with insurance, all insurances are, changing. Let's put it this way. They're changing fast.
Constantly.
They're putting some downward pressure on reimbursements. In fact, I
Yep.
just talked to somebody up in Michigan. Blue Cross Blue
Mhm.
Shield is basically saying in Michigan, people who are, I believe, pre-licensed cannot bill
Mhm.
underneath you anymore.
Oh,
So
yeah,
that changes the entire business
it
model
does.
of huge, large group practices. So I don't know if that means they have to then out of
Absolutely.
pocket expenses or what that means, but that's
Mhm.
what he was telling me. I mean, it's like, so I was like, man, private pays, you just don't have to deal with that stuff. It takes longer to build a brand, but my goodness, does the
It
insurance,
does.
they are clamping down. Well, okay, well, let's keep moving because I'm
Let's do
that's
it.
like another podcast is just how the
Right,
insurance
that's a whole other one in and of
taking
itself, but
holding
you're
money
right. Just to
hostage.
give one line on that, no, you're absolutely right. We've seen that. And here's the thing, even if you do accept insurance, try as best you can to at least mix in some private pay clients in there. You know what I mean? So be sure to still be marketing yourself, doing those things, because that still raises your overall average up
Yeah,
and helps you keep more profits. Because then, just the simple numbers of it, the simple math is that gives you more wiggle room to do better things for your
yeah,
staff, as opposed to, hey, if we have an extra $50, whereas, Blue Cross, Blue Shield, Cigna, whoever is reimbursing $98, 100, 102. Well, if we can move that up to 150, guess what? That gives us a lot more wiggle room to do a lot more with. So
yeah,
I absolutely agree with that.
yeah, yeah. All right, well, let's get to those tips, man. We set it up.
Yes.
We set it up.
Absolutely. Let's jump into it. So the first and biggest one for most practice owners, and most people, I guess at this point have heard some version of it, but is looking at when you need to become an S Corp. So what an S Corp is essentially your business now becomes essentially a corporation, and you
Mhm.
are a now W-2 employee of that corporation. So you, just like everybody else, you are receiving a paycheck from your own company. So the reason why this is so important is because when you are a with just a regular LLC or PLLC, you report that to the IRS on what's called a Schedule C form, right? So, but the problem is with that is that you have to pay self-employment tax of 15.3% on that. And we were just talking about already, when we're looking at profit, when we're looking at margins,
Mhm.
things already get tight for a lot of practice owners. And so that's why knowing those numbers is important. But then when we add in taxes, as we said, taxes is going to be one of your biggest expenses. We have to pay another 15% in taxes on top of that. So that gets really, really tough, and gets some really tight for some practice owners, just to be perfectly honest. So
Yeah.
then let's move into the S Corp realm. So why is it beneficial to move over to an S Corp? Well, the reason is because when you make a profit, let's just say, hey, you have $150,000 practice, right? And then we have, let's just keep it simple. Let's say we have 50,000 in expenses, we have 100,000 profit. Well, guess what? From that self-employment number I told you, that's another $15,000 that you have to pay in self-employment taxes. Well, now enter in an S Corp where you pay yourself as a W-2 employee. You're only paying those self-employment taxes on the salary that you pay yourself. So more times than not, this slices that self-employment tax in half. So now instead of paying an additional 15,000, now maybe we're only paying 7 or 8. That's real money that's back in your pocket. And so just to kind of give a number on that one too, because most practice owners ask, hey, when should I be looking at, potential S Corp moves, so on and so forth. We run the numbers on it, and of course, as I say, it depends. Consult with your CPA officially, but in general, what we've seen is if you're at least at about 50,000 net, like, hey, we made 100, we spend 50, we've got a 50 net after expenses. That's usually when it starts kicking in to save you a good chunk of change. Usually, right at about that amount, it's saving you at least, 6,000-7,000 bucks. And that's real money, back in your pocket that you're not having to pay the IRS.
Yeah, and it's not a big it's just a sheet of paper, I think, right? You just write sheet of paper, submit it to the IRS. I don't even
Hmm.
know name the form. That's all you gotta do,
Yep.
and you're an
I'll
expert.
tell you, it's the Form 2553 for anybody looking for it. Form 2553.
Cool.
Submit that in. If you need help,
And
of course, reach
can it
out.
be for the entire year? Like even if you're I don't know, maybe you're in
Yeah.
October or November and you're like, actually,
Mhm.
this makes sense. You can submit that and actually have it apply for that entire current year that you're in.
Yes, actually you can. So I'll tell you two. That's a great question because there's two things on that. So the official deadline for a S corp election is March 15th of whatever year it is. So
Okay.
in 2026, that deadline was March 15th for the current year.
Got it.
However, there is a late election that you can do for an S corp, and we do this all the time for clients. You know that you do have to have like the legalese in it when you submit the form. That's what we help clients with all the time. But you can still do a late election S corp after the March 15th deadline. You just have to, make sure you word it right. You have to set it up properly. But there is a way to do a late election.
Interesting.
So even later in the year, you can actually still have them backdated to January 1st so that you can see what it's like all year. So, perfect example, this is one of the tax planning tools in our tool belt because sometimes we have clients, as I mentioned, hey, maybe that first year did pretty well. This is maybe their second full year. And they're like, is it going to be enough to be an S Corp? Should it not be? But to be honest, that's hard to tell by March 15th, so we want a little bit more runway until later in the year. And so we start looking at that honestly around now. Hence, as we were talking about tax saving season, this is
Mhm.
where that comes into play. Where once we're halfway through the year, once we're into the late summer, early fall, that's when we can really look, be like, hey, based on these projections, this S corp is going to save you $7,000 this year. Let's do a late election. Let's get it backdated to January 1st, and there's $7,000 back in your pocket.
Yeah, love it. Love it.
Yeah.
What's your second tip?
Absolutely. So, one of my favorite tips that is kind of underutilized is what is called the Augusta Rule. So, the Augusta Rule is where you, as a business owner, has a separate entity, and that entity can actually rent out your house, your personal house from you up to 14 days a year. And guess what? That becomes a business deduction for the business, and that money that comes back to you is tax-free money. So it's kind of the best of both worlds. And just kind of gives a slight bit of background on this. The reason why this came into play, if anybody has ever heard of the Masters, the golf tournament, the Masters, it's held in Augusta, Georgia. That's why it's called the Augusta Rule, because those people have, big multi-million dollar homes. They wanted to rent out their homes to people coming in for the Masters. Well, by doing that, they didn't want to be considered landlords because it was just a few days a year. Well, when that happens, then the IRS, came in with a law. Hey, you can rent out your own personal house for 14 days a year and it not be considered actual income. So that's the biggest catch of it. You do have to have a agreement, an actual lease agreement between yourself as an individual and the actual business. But we help clients with that all the time. And we've seen that, just depending on where you live, the pricing, because it does
Yeah,
have to be however you would rent out your
like a
home,
market
let's say
rate
on
type of thing. Yeah.
Airbnb or on Peer Space, one of these home rental kind of things. Whatever you would charge there is what you could charge your business. We've seen that can range anywhere from 700, 800, $1,000, just depending. And guess what? You can charge your business that, your business pays it, comes to you tax free. That's an easy, 7, 8, 10, $12,000 tax tip.
What are some of the business use cases that you've seen practice
Yeah.
owners use to justify the business expense from renting their own house from the business?
Yep. So basically, it has to be any type of business meeting. So
Okay.
you have a business meeting, it does have to be documented. We do have to have the lease agreement. So, of course, there are some, I's to dot, T's to cross on it. But, we help clients with that to line it up. But it is really just a business meeting that is documented at your home. And so that is what makes it a legit business deduction, as long as
How
it's a
long does the
meeting that
meeting
we
have
have the
to be?
meeting minutes.
Does the meeting
So
have to be like
typically,
half a day
yeah,
or like what's the
yeah, so typically I would say use a full day because you can use up to 8 hours. And so I like using the entire day to make sure that we maximize it, because you
Mhm.
could have it for less, but hey, if we're going to do it, let's maximize it to its fullest value. And so typically you would want a, full 8-day meeting. Just think like a typical work day. of all the things that you are going through, that you're, talking about, that you're working through in your business. And another question I get is, hey, does it have to be, multiple people there? Does it have to
Yeah.
be a whole group? And actually, crazy enough, it does not have to be a whole group, as long as it is a legit business meeting where you're documenting the things that you are going over. It can count. Now, one caveat on that for therapists, because I get this question, is, hey, what if I'm having, virtual meetings or whatnot, with clients? That does not count. So this has to be more of a direct business meeting, with multiple people or with yourself, where we document what was going on, who was there, the fair rental rate, and then your business can pay that. You don't have to pay income tax on it. It is a phenomenal deduction.
Oh man. Yeah, you could do an episode just on that. On a
Yes.
deep dive on it. That's a cool, because I've heard of the Augusta Rule, but I was never like,
Yeah.
well, I wonder if that, like, how to actually apply that. And
Yeah.
it's a cool
Absolutely.
idea.
No, it is a phenomenal rule when done right. Like I say, a few I's to dot, T's to cross on it, but there are great ways to do it. And I tell people this, like, the tax code is there for a reason. So it's nothing to be scared of. The tax code is, thousands upon thousands of pages, and most of them are on how to tell you how to write off different deductions. So they're there.
Yeah.
We just have to implement them. I tell people this when, therapists start a private practice and they get into it. Hey, you are now running a business. But think about it this way. If you are, I'm a huge sports guy, I played sports growing up. So pardon
Yeah.
the sports analogy for our therapists who aren't in the sports. But here's what I tell people. It is hard to play a game if you don't know the rules.
Yeah.
If you're playing football, basketball, pickleball, if you're getting on the court and you don't know the rules, you're behind the 8 ball. You
Yeah.
don't know the rules of engagement. Well, guess what? When you're running a business, it's the exact same way. So you're jumping into the business world with all the IRS code, rules, and regulations, but you don't know the rules.
Right.
So that's why it's helpful to get somebody trusted who can help guide you through that, because there are things that are out there that we could be deducting that are absolutely legal, but if you don't know about them, you can't use them.
Got it. And you can actually, if you have multiple businesses, as long as it doesn't, go over the 14 days for your personal, income, multiple businesses can do that for you.
Absolutely.
Okay.
Absolutely. You're very correct.
All right. Well, what's the third and final tip?
Yes. So the next big one is, boy, I tell you, this one that goes underutilized as well. And we were chatting a little bit before we started recording about our kids and how you can actually pay your kids through your business. And that is such a huge deduction that most people don't utilize. And as business owners, where the family is the business, oftentimes
Mhm.
bringing in kids to do actual work within their business can be so very beneficial. We were just talking about how we met at a conference a few weeks back, and then I just came back from another conference. Well, I'm getting promo materials together, packing them up, heading out to the conference. Well, my son is 9. And so guess what? I had him doing some of the work for that. Hey, son, put these stickers on here. Hey, I need you to do this. I need you to do that.
Yeah.
Different things like that they can be doing. And guess what? I pay him for that through my business, because that's actual legitimate work. They have an actual wage, and you set up a bank account for them, and you pay the business from the business to their bank account. And guess what? Crazy enough, you can pay your kids up to $16,000 per year to
Yeah.
work in your business. And that becomes a deduction for you, and they don't even have to file a tax return. So if
Yeah.
you think about just 2 kids, that is now
Incredible.
$30,000 that you could be paying for stuff that you would have been paying anyway.
Yeah.
So I'll give you a perfect example of how we set it up. So, my son does the work through my business. I pay him to his bank account. Well, he also does karate. For some reason, they feel like they need to charge me monthly for that. So they charge me monthly for karate. He does basketball camps as well. But
Yeah.
guess what? I take those automatic debits, and those come out of his bank account. So now that's off of my personal budget, because it's coming out of the money that he earned that I am now getting to deduct from the business. So that is a huge one that a lot of people miss.
And that's considered earned income for a child. And from what I understand, you could set up an IRA for them.
Yes. Oh, Brent, you're talking my language.
Yeah.
So
And
I wasn't.
can you imagine?
Uh-huh.
I I haven't done the IRA thing yet with our kids, but they do have their own bank accounts, and our
Yep.
businesses have paid them a little something. But I was
Yep.
like, man, imagine at 9 years old, them owning
Yes.
SpaceX stock
Yes.
or something that,
Yes.
their favorite business. And then imagine like by the time they're 50, they could be like multimillionaires
No,
because
you are
your
absolutely
time is your
right.
best friend when it comes to the stock market.
It is your best. No, you are so right. I was gonna say I wasn't gonna get this nerdy on it, but you forced it out of me. But no, this is an additional tax planning tip. So let's just say you have a kid who you can, get close to maxing out. Let's just say it's 15, 16,000. It's a little bit more. Let's just say, hey, 15,000, right? You can put up to 7,500 in an IRA. So now you take that money that you paid them throughout the year, it goes to their bank account. Now you take that IRA of 7,500 and you can create a custodial IRA for your children. They get a retirement account at, like we're saying, at 8, 9, 10 years old. And that money grows and grows and grows. Talking about setting up your children for success down the
Oh
road,
man.
on top of getting a deduction. And here's the beautiful part about it that most people don't know. So let's just say, hey, we have that set up and they go off to college, right? You can actually take out the principal of what you put in, and there are no tax penalties on taking out the principal.
Oh, interesting. Yeah.
Exactly.
I mean, yeah, you just got to get creative with the legitimate work that their kids are doing
Yeah.
for your business.
Yeah. Absolutely.
I have a family member who's a photographer
Yeah.
and they have young kids, and for promo pictures for their website, they're taking pictures of the kids and doing like
Yes.
set designs and things like that.
Yes.
I mean, I think they're 3 or 4 years old. I can't remember.
Yeah.
They already have an IRA.
Exactly. As I
Crazy.
say, it's hard to play a game if you don't know the rules. And there's
Yeah.
so many rules out there that we can be leveraging to, help reduce that tax bill, to make therapists more profitable by, implementing things that you probably just don't even know about.
Yeah. Well, we're up against time here. How can people know more about you, Alan, and what you do?
Yes, absolutely. Man, this was so fun. Pleasure to be on. You can visit me at thetherapistcpa.com. That is our website. You can find me on Instagram too and LinkedIn. Exact same, the therapist CPA, or search Alan Pruitt CPA. I would love to chat if you have any further questions on, hey, how can I make my practice more profitable? How can I reduce my tax bill? These are the conversations we love having with our therapists to help make you run a practice that supports your life, that's sustainable, because we are a firm believer that profitability is sustainability.
Yeah, I love that. Well, thank you so much for joining me. And just a reminder that all the content on the TheraSAS website and even the Brand Your Practice website and the podcast and other media reflects my own opinions and should not be taken as legal advice, financial advice. If you need financial advice, talk to Alan. And investment advice, please seek out the guidance of professionally trained and licensed individuals like Alan before making any decisions. Some links in the descriptions may be affiliate links. All right, everyone. Thank you. If you found this helpful, please share, like, subscribe to the YouTube channel, and we'll see you on the next podcast. Thank you.